Okay, give me 1 second. How's everybody doing today? There we go. Okay, so let's go. Um, let's get started. So this is our Ask Me Anything session for this week. If you have questions for me, if you're watching on Zoom, which means that you're a member of our free community Zero to Pitch, then guess what? You get priority and we'll answer your questions and we'll get your questions answered first. You can put those questions in the chat box on Zoom or YouTube, doesn't matter, just pop them in there and I will be happy to answer them either way. So anyways, with that, let's get started and let's see what our questions are for today. I hope everybody's doing really well today. Beautiful day here in Northern California today. So let's get started and let's see what we've got. So let's see what our first question is. Okay, so we have a question on co-founders, okay, which I always like answering. Over the past few months, I have had several conversations with a potential investor who is interested in funding my company. They have had some reservations and objections about moving forward with funding, but have not closed the door just yet. They have been very responsive and transparent about their hesitation and have given me an opportunity to change their mind. For example, they were concerned with the demand from potential customers, but I was able then to keep the conversation rolling by following up with a survey to our target market. Okay, this showed great results. Okay, that's fine. The investor followed up with me recently after another review of my pitch deck with their partners, and I was able to confirm their final reservation is that I do not have a co-founder. This is a big one. So I have noticed that this is a common theme from investors. He's right. It is a common theme from investors, as I give you my commentary. I have noticed this common theme from investors that I have interacted with, and so far they tend to stay away from solo founders. This is true. It is hard for solo founders to raise money, even though I've worked with solo founders that have raised money. I was told that they will continue the conversation and continue to move towards funding once I have a co-founder. What's the question here? So my initial thought was, no way am I going to give equity to someone that has not been part of the process so far with hopes that they move forward with funding. This is a backwards way of thinking, so I'll get to this in just a second. After taking a break and looking at it with a cooler head, I understand that with the right co-founder, I may be able to accomplish things that would not be possible solo. Okay, I plan to approach co-founders, some MOU kind of thing. What are your thoughts? So, okay, so here are my thoughts. The deal with co-founders and the worry that, oh my God, we're going to give up all this equity with co-founders, that's a fair worry, but there are ways of protecting yourself. And the basic way that we protect ourselves is that we essentially have vesting, what's called reverse vesting for the equity that you're giving somebody. So this is stock we're giving somebody. So let's say that a typical co-founder arrangement was either like a 50-50 arrangement, 51-49, 60% for you, 40% for your co-founder, something like that. That's a very normal co-founder relationship, would be something like that. So what happens, though, the worry is, oh my God, I'm giving this person 40% or 50% of my company. What happens if this person leaves? I've now given 40% of my company away. Well, that's where reverse vesting comes in. So the way that this works is essentially, yes, you own 40% of the company, but you only own it over certain conditions. The first condition is that we have what's called a cliff in our vesting. The cliff means that for a certain time period, nothing vests. Typically, a typical cliff would be 1 year. So for the first year that you are a co-founder, you vest nothing. Then at the end of that year, typically you'd vest a quarter of your stock. So suddenly the 40%, you'd vest 10% in that time period. But up until that point, it's almost like you could think of it as a probationary period. So that's how you're protected in all of this. That's the smartest thing that we can do. That keeps us out of trouble just in case things go bad, because guess what? Many times things do go bad. Things don't work the way that we want. So this is how we protect ourselves. This is the smartest thing that we can do. So the reverse vesting protects ourselves. Then this idea of, oh my God, look at all this. I've done all this work and I've worked with people. I've worked for years on this. Now you're telling me I've got to give up this huge percentage of your company. Yeah, you do. If you want really good people, think of it this way. I'll give you a couple thoughts on this. First, do they care about the fact you've been working on this for years? The answer is no. They care about themselves. So a very good person is going to have multiple options, multiple opportunities. So to entice them, you have to make them a partner with you. You can't think it's 90% for me or 99 for me, 1 for you. That doesn't work. It's got to be fair. So that's the first piece of it. You have to think about the other person in this relationship, not you. The second piece of this is that, and now I'm forgetting. Let me think about it for a second. So the second piece of this is there has to be a reasonable split between the two of you. So one is that I know what the second thing is. I'm sorry. The second piece is it's going forward, not looking back. Equity is all about going forward, both for our co-founders and for our future employees. It's the value they're going to bring going forward. The person in my company that got the most equity of my co-founders was the last co-founder that we brought on. He got the most. Why? Because he was bringing the most. That was what was right. None of my other co-founders complained. It was fair. It was reasonable. And it was what we needed to do to get the best people. And you know what? Let me give you the third thought on this, which has to do with you. And this is the question you have to ask yourself. Would you rather have 99% of nothing, or would you rather have 50% or 60% of something? Or even a lower percentage of something? I don't know about you, but I'm in that something camp. I'm a pragmatist. I'd rather have a smaller percentage of something than 100% of nothing. And that's the way you have to think about this. So I hope that helps. So you have questions for me, put them in the chat box, and I will be happy to answer them for you on Zoom or YouTube. So let's go to our next question. All right. Hi, Brett. I have a person who is interested in investing in my project, but she is not a professional investor. So I doubt she will give me a term sheet. You're probably right. I'm planning to pay her back with royalties from sales of my product. Is that okay? Yeah, it's okay, but it's not smart. How much money would be fair to pay her back, or for how long? Thank you. I don't think this is a good way to go personally, because the idea of, if you think about it, money is kind of like our lifeblood. Money and time are kind of like the two things that we need the most when we're starting a company. So let's say that you're raising, I don't know how much, but let's just make a small number up. This is all relatively small because there's still big amounts of money. But let's say our initial investment from our friends and family is $100,000. So we want that $100,000 to last a long time. Yes, you can pay somebody back in royalties as you make sales. That is a way to do it. However, in an ideal world, ideally, you'd love to have that money forever, or at least until you get your next set of investors and you give them equity. Now, the reason why we'd want to do it this way, and it all depends upon what your business is. If your business has a point where there's some sort of exit for it, in other words, it's either going to be sellable, somebody's going to buy the business, or somebody's going to acquire the business, or the third option is magically somehow or other we're going to be on the public stock markets. One of those three. Then you're much better off giving equity. But let's say you don't have that kind of business and you just need some sort of a loan to get started. Then what you're describing is a way to do it. And the question is so broad, I can't answer it. But ideally, you'd want this to extend out as long as possible because money is everything. Money and time. Those are the currencies we have at the beginning. So we want those to last super long if possible. So I don't know the particulars of your situation. It's going to be too hard to go back and forth in a webinar chat to answer, is what I would tell you. But you'd want that to last a fairly long time. And the other way you can do it is doing a loan. So if you have $100,000 investment from this person, you could pay the loan back with some interest on the loan over a period of time. Typical business loan might be 3 or 4 years in time that you would pay back the principal and the interest. But if you think about this, that's a lot of money. So let's say we're paying back $100,000 and we're going to go pay it back over 3 years, plus we're going to give interest. So if we're paying that back over 3 years, that means every year, maybe we're paying a third of it back or something. So that's like $33,000 a year plus some interest. Let's say it's another $4,000 or $5,000 a year. It adds up. So that's why ideally you'd prefer to do the equity piece. Much better way to do it. You're right. You're not going to get a term sheet from somebody like this. You get to set the terms. If we're dealing with people who are not experienced investors, then you get to set the terms. It sounds kind of like a loan. The royalties would be ideally a little bit better way to pay somebody back because you give them royalties from your sales. At least you're selling something. And that's going to take whatever time it's going to take, to pay somebody back. And you'd have to think about that. So a typical, I'm sorry, I'm just thinking more about this. I don't know what the typical royalty might be, but somewhere probably, I don't know, between maybe 10 to 20% of your sales revenue. So that's what you would give up. And you pay them back, and you want to pay them back a little bit more than the $100,000 they're giving you, because I think that's going to help you a little bit more. If you do it that way, or help them, it's kind of fair, right? They shouldn't just get the $100,000 back. They should get something for their time, because they're loaning you money. It's pretty risky money. So anyways, those are my thoughts. I hope that helps. Okay, so if we have questions for me, we can put them in the chat box on Zoom or YouTube, and I'll be happy to answer them for you there. And if, by the way, this is for my YouTube audience and actually both audiences. If you want to take it up a notch, if you want to grow your business faster, if you want more help from me than just these Ask Me Anythings that I do, which are somewhat limited in what I can provide in terms of help, and you want a community of like-minded CEOs to work with, over my left shoulder, right there, join Zero to Pitch Gold. Just scan that QR code. So I'll have $150 a month right now. Massive bargain, about $20,000 of value for $150 a month. Can't do better than that. You can quit anytime you want. I have office hours literally every day where we go into a lot more detail than this in terms of answering and asking questions, helping people with their pitches and their pitch decks and their businesses. You name it, we do it. Plus, there's a classroom there where there's some pretty detailed classes on how to build a really good pitch and a pitch deck and other things in business. Get all of that for $150 a month. Or if you join for a year, you get 2 months off of that price. Plus, you get a one-on-one meeting with me for free. $2,000 value for free. Not so bad. Okay, so let's see. Next question. In a video, you said angels ask for 30x the investment. Would that be adequate? For the adequate in the CAS, I don't know what that means, but if an angel's they're looking for 30 times their money, ideally. In this case, yeah, that's essentially what they're looking for, 30 times their money. Now, I'm not sure if you're talking about if you're doing royalties or something like that, but the return on the investment, typically. And we don't limit this, by the way, just so you can understand royalties. Oh, that's insane. That's absolutely insane. You would not make that deal in royalties. You'll be paying money in royalties till you're dead. No, don't do that. That's dumb. Sorry. If somebody's just going to give you a loan and all they care about is your success, then pay back the loan, pay it back with some interest above the market rate for interest, whatever that is today, whatever the interest rates are. But don't do 30 times royalties. My God. That, so if essentially it's a $100,000 loan, you're going to pay them $3 million in royalties. Wow. That's insane. Don't do that. That's essentially for the next amount of money that you have, that's going to make you uninvestable. Don't do it. Okay, let's go to our next question. Hi, Brett. Thanks for this. You're welcome. My startup manufacturing company has $550,000 in POs and no cash to execute them. Well, congratulations on the purchase orders. That's good. Unfortunately, this makes any type of loan impossible since we have orders but no cash flow. Have been rejected for everything, including CBA, okay. And factoring seems to rely more on financing inventory. How do I get the cash to get these orders filled? Okay, so my thought would be, why don't you get customers to prepay you? Give them something. Give them some sort of discount for prepaying you or some sort of extra service for prepaying you. So if that's a way to do it, if you prepay us, you go to the front of the line, we'll give you 20% off. That's a way to do it. Another way to do it would be if you prepay us for part of it, and it doesn't even have to be all of it, but something to get the orders built. That's the second way to do it. Third way to do it would be to ask for, say, okay, we'll give you this extra service for free, something else of value. So those are three ways you can motivate people to give you money sooner, which is essentially what you're looking for, since you're saying, hey, I can't get a loan. Now, there are other types of loans. There's bank loans, which are really hard for small companies to get. But there are other companies, it sounds like you're located in the US based on what you're writing here. Small Business Association loans. Yeah, those are difficult to get too, but there's a third group. There are smaller loans that are given out. The company I'm thinking of that does this, and I think they have IPO'd actually, so I think they're public, is a company called Fundbox, fundbox.com. They have a model, essentially, you go apply, and the way that it works, they have an algorithm which will look at your information, and depending upon how much money you need, they'll tell you yes or no. And then essentially, I think the way that they make it work, which reduces their risk, I worked with a company in the UK that was doing a similar thing to this, is that the way that they make it work is they have you pay back a portion of the loan every single day. So you have to kind of think creatively about how you're going to do this. I mean, the fourth way you can do this is you go raise some money somehow. If you've got $1 million or $600,000 in orders, that's something. So you can get people to hopefully invest in you because of that. That's yet another way to do this. So you have to kind of think creatively here in terms of how am I going to go make this work? And you have to go find somebody that's going to back you and believe you. If you've got the orders, then people must want something. So that's what I would think about. All right, so if we have questions for me, let's see, you can ask them and I will be happy to answer them. Okay, next question. This is from my Zoom audience. Again, the Zoom audience gets priority, so let's go. And next question is, I was approached by a business/investor person I know who wants to introduce me to another investor who is well connected in the industry my products are designed for. What kind of agreement should I make to minimize the amount of cash to pay out for services and commissions in general? I believe you're talking about for the business person/investor that is planning on helping you. So, okay, so the typical answer here, I'll tell this in terms of a story, but I think it's a reasonable story to tell, is that And I remember one of my investors telling me this story about how he had helped this other investor. He had introduced the other investor, and the company turned out to be a real success. And the investor, in turn, these were both venture capitalists. The other one venture capitalist who introduced the winning venture capitalist, the guy who ended up with the big return on the investment, sent the guy who was an investor in our company. He sent him a bottle of wine. That was the payback for the thank you for the investment. You have to be a little bit careful about what you're going to give people for finder's fees, is kind of the moral of the story here, in terms of how much are we going to give somebody for finder's fees? What are we going to give them? Bottle of wine is a pretty good deal for a lot of these things. Most people, if they're trying to make a huge amount of money off of you, be careful. Because new investors, especially here in the United States, depending upon who they are, really don't like that. I know in other countries it's frowned upon less, but here in the US, there's more of a stigma about using brokers and people like that. This person just kind of sounds like a friend. So it's like you can figure out some sort of favor, to do this person. You maybe give them a small amount of equity or something like that in your business. That's a way of doing it that works. Something small, something reasonable, to do less than. I'll tell you another story. Actually, this wasn't one of my investors, but this is a mentor, a friend of mine who was also a venture capitalist, said to me, I wouldn't care if you gave your dog 0.5% of the company. So if you gave this person like a restricted stock grant or something like that of 0.5% as a thank you, if he's successful in his introductions, that would be fine. Nobody's going to bat an eyelash over it. But if you're going to give a material amount of money back, like let's say, I don't know how much money you're raising, but let's say you're raising $5 million, making up the number, and you're going to give him 500,000, like 10%, $500,000 back. That's not a good idea. Those are the ones that kind of hurt. But if you're going to give them a small amount of equity, nobody's going to care. So use those as kind of parameters and how to think about this. Okay, any other questions we've got? Put them in the chat box. And if we're watching on Zoom, we can put them in the chat box in Zoom. If we are watching on YouTube, we can put them on the chat box in YouTube, and I'm happy to answer them in either place. And that's fine with me. Either way is good. Hang on one second. That. Okay, there we go. So anyways, if you have questions for me, that's great. And while I'm waiting for some more questions to appear, and then I'm going to look for some other questions as well. If you are interested in taking it up a notch, if you want to grow your business faster, if you want to raise your money quicker, who doesn't want to raise money quicker and really get expert advice on what to do, join Zero to Pitch Gold. There's the QR code over my left shoulder. Scan it, all of $150 a month to join, about $20,000 of value. You can quit anytime you want, and it's a great deal. It's a great group of people in there as well. So do that if you really want to take it up a notch. So let's see what our next question is. How do I get in front of more investors? I've been cold emailing for several months and have only had a handful of meetings. Warm intros are equally as difficult. Yep. Okay. Where's the question? So that's a pretty broad question. We have to look at what's wrong with your cold email strategy. I don't know how many emails you've sent versus how many meetings you're getting. In my case, just to give you kind of an idea, cold emails work, by the way, just so you know. So they do work. They're not, look, warm intros are always going to be the best thing you can do, but cold emails absolutely positively work. So with cold emails, I was getting about a 30% rate of being able to get meetings with cold emails. The whole key, and I have a video on this, if you search for it, you'll find it on my YouTube channel on how to do this. But if you think about kind of the sequence with cold emails, right? The first thing is always the headline of the email. What's the headline? Are people opening it? So we got to get people to open it. They don't open it, doesn't matter what's in the email. So that's the first step. Then the second, and the headline should be, this is kind of a general theme here, which is going to sound backwards, but it's really true. Don't oversell. Do not oversell when we're doing cold emails. Make it straightforward to the point. Like, let's say, for example, you have a SaaS business, then you would say something like, SaaS investment opportunity. That would be the title of your cold email. And then in the body of the email, we want to be right to the point, who we are, what it is that we're doing, and what's different about us. Kind of those three key things. And we want to be kind of point by point by point. And this shouldn't be too long. This shouldn't be like I got an email from somebody yesterday that was just like, wanting me to invest in their business. It's like this volume of things. And it's like, delete, because it's just too long. You're going to get maybe 30 seconds, if you're lucky, to 90 seconds of somebody's time. So you have to think brevity counts. You got to be right to the point. Then the final piece is the ask. What should the ask be? Well, I'll tell you what the ask shouldn't be, which is again going to sound backwards. The ask shouldn't be, hey, are you free for coffee? I need 30 minutes of your time, or something like that. That's going to immediately send people backwards because they don't know you. And it's one hell of an ask, to ask for 30 minutes of somebody's time if they don't know you, especially when time is the most precious commodity that most investors have. So what do we do instead? We make the ask, let me know, something like this would be a way of doing this. Let me know what the next steps are. Something like that, that isn't this like, believe me, all you have to do, if they like what you're doing, they have your email address. If they're interested, if you just do something like that, they're going to write you back. You don't need to do anything more than that. You can keep it really, really super simple and make your life a hell of a lot easier. That's what you do. That's how you make things better. That's how you get a better open rate on your cold emails. And your warm intros, I don't know what to tell you with warm intros, because you haven't given me anything to work with in terms of that. Warm intros, just so everybody knows what they are, warm intros are people that you know who can make an introduction to somebody that they know. So if I know Jim and Jim's an investor and you ask me, hey, can you introduce me to Jim? Then I can go say, I can use some of my capital and say, hey, Jim, would you be interested in this person's company? That's essentially the way that it works. It's no more difficult than that. So it's just a matter of what is it that you're asking for? And what is it that, and how are you asking? And are you asking people that can actually introduce you to the right people? Okay, let's go to our next question. Hi, Brett. I sent a pitch deck for review. Is it possible for you to check it out? Well, let me explain how we do pitch deck reviews and what I do for that, and what I will do and what I won't do. The answer is no. I will not do ad hoc pitch deck reviews for people. I don't have the time. Sorry, I get inundated with requests like that. Can't do it. However, what I do is once every other month, and I will do one for my Zero to Pitch community, the free community. I'll do one in about 2 weeks. I think 2 weeks from today, I'll do a pitch deck review only on Zoom, not on YouTube, for that community. So if you send me your pitch deck on Zoom through the school community, my school community before then, yeah, I'll review it during that pitch deck review at that point in time, as long as I haven't reviewed it before. People whose pitches I haven't reviewed before get priority versus people's whose pitches I have. And if you want to take it up a notch and really look, I'll go deep. I'll give you critical feedback on what's going on. But if you really want to make your pitch better, then join the paid group Zero to Pitch Gold. I review pitches every single day in there, and you'll get better infinitely faster. Okay, let's go to our next question, also from our Zoom audience, which is nice and active today, which I like. Okay. Maybe I didn't understand well the 30x payment to an angel. Is not that 30x the amount the angel invested? Yeah, it is. 30x the amount. So if they invest $100,000, then what's 30 times 100,000? 3 million. So if you're going to pay back royalties, this is the thing, right? You're going to pay back royalties of $100,000 by paying back 3 million in royalties. That's insane. That's my point. Okay, let's go to our next question. How many cold emails are too many? And what is a good frequency to send them if no response yet? I would say, okay, it's a really interesting question. So the way I would do it is I would send them in batches. Like if you've got a list of, let's make up a number. Let's say you have a list of 500 potential people on your list, which is a pretty large list. I wouldn't send out all 500 at once. I might send them in batches of like 50. Send out 50, see what comes back. If nothing's coming back, nobody's responding, okay, something's up with either the headline of the email, they're not opening it, or the body of the email, something's off. Make some adjustments, try again. See if something improves in what you're doing, and then try again and try again. That's the way you've got to do it. But don't do everything all at once. That's the smartest way you can go at this. What's the right number? There is no right number. It's just as a total number, it's, hey, what does it take to get an investment? Just so we're normalizing things here. For every 100 face-to-face meetings an angel investor or a venture capitalist or a private equity person takes, they likely will invest in one company, just one, 100 to 1. So I don't know how many emails they get before they open them, but you can imagine if I got a 30% open rate, and all I was doing, and not 30% open rate, but for every 3 emails I was sending, I was getting 1 meeting, doing cold emails. Well, let's say your success rate was the same as mine. To get 100 meetings, that means you have to have a list of at least 300, and they've got to be the right list. This is the other thing. You have to look at, if we take a step back, we have to look at, what are we doing? Are we sending these to the right people? That's the other part of this equation. So we have to find this combination of things. Number one, are they interested in my type of company? There's enough information out there that we can research to find the answer. Number two, do they invest in my stage of company? So probably most of the people listening to this right now and watching this are early stage. Do they invest in early stage company? Do they invest the amount? Let's put that as number two, the amount of money that I'm interested in. Number three, do they invest in the geography that I'm in? So if I'm in London and I'm sending out requests to people here in the Silicon Valley, and that person, and we could do enough research to know this, will they invest in my company? Do they invest in companies based in London? Yes or no? So you have to find the intersection of these three things. If we're sending requests to people who have no chance of investing in us, just wasting time. So you got to get this right. I hope that helps. Let's go to our next question. Should I keep trying to reach out to fund something founders for warm intros? These have been by far the most responsive. Well, if they're the most responsive, then keep doing it. That's what I would do. If you're finding success with something, then double down on it. That's the smartest thing in the world you can do, is if you're seeing something be successful, you're seeing something do what you want, then do more of it. Okay, let's go to our next question. Okay. This is the same thread I've had with this person regarding the 30x payments to somebody. And And he's saying, then I guess my 30x payment makes sense only if my company gets a big valuation over time and gets sold. Well, the problem is then what you're talking about, instead of like a loan, instead of guaranteeing a payment, it's essentially equity you're giving the person. So they get what they get. So in other words, if they have, if you give somebody for their $100,000, let's say that they get, I don't know, 10% or something like that, whatever it might be, then okay, so be it. They get their 10% or whatever it is. I don't know. And that's going to get diluted over time. And whatever that percentage works out to, whenever the company's sold for, that's what they get. That's all we need to do. Okay, let's go to our next question. Whoa. 9 questions. I don't know how the hell I'm going to answer all these. All right. Okay, let's go to our next question. So, all right, so let me see. So, the 9 questions somebody just asked me in one question. So that's a lot of questions. Okay, so let's see. So as a solo founder building a consumer brand from Pakistan, what should I ruthlessly prioritize in the first 12 months? I have no idea. I have to think about your particular situation, which I don't know. That's the best way to think about this is, okay, what is this really going to look like? And to me, it's okay, getting product to market, probably revenue and sales would probably be the most important things. Can you get customers to buy? That would be my guess. So that would be my way of thinking about this would be, okay, let's go get customers. Let's go get revenue. That's the way to think about this is I would be thinking about my revenue, my customers, the metrics around that, to see what's going on. Focus on the most important thing, like 1 or 2 things at most. I don't know what kind of team you need to build out, which is the other thing, because there's the classic thing about startup CEOs. We got to recruit, sell, sell, sell. So those are kind of your 2 basic things, no matter what you're doing. Okay, second question. What's the best way to validate my product and brand vision without burning too much capital? Get customers and do it in ways we're not spending lots of money. In other words, if we can avoid spending huge amounts on advertising and things like that, and we can use our network, use word of mouth, go door to door. Those are the best ways, to validate a product in a business. You get people that you know to buy from you. That's a wonderful way to start in any business. Your friends, your business associates, your whatever, always a good way to go. Question number 3, how do great founders balance between long-term vision and daily execution? Okay, well, the idea is that we have small short-term goals which lead up to the long-term goal. So we keep the vision in mind, but we understand these are all stepping stones to get there. That's the way that you do that. Question number 4, what are the biggest mindset shifts I need to make to go from creator to a CEO? Well, you want to keep doing what you're good at. So if you're creative, keep being creative. What you have to learn as a leader is you got to be able to run a company. So you've got to be able to communicate with people, your customers, your vendors, your investors, your team, all those various people. You've got to be able to communicate. You got to be able to manage money. Can't manage money, you're going to be in deep trouble. You have to be in the details. You have to be really detail oriented, especially at the early stages of being a CEO. Those would be things that pop right into my head. And you've got to be able to have a vision of what the company is going to be, and you have to have a culture. Usually a strong culture works. Culture where nobody wants to leave the company. Number 5, if you were in my place, starting a niche beauty brand for an underserved middle-class market, what would be your exact roadmap for the first year? I can't answer it because I'm not in your place and I would fail because I don't know niche beauty brands. You do. Keep it simple. Think logical. Get customers. If you have a product already, narrow the product base down, get people to start buying something as a starting point, even if it's not the whole way to your whole vision. That's the smartest thing in the world you can do. Number 6, when should I start building a team and what roles would you hire first? Well, I would start building my team tomorrow. In fact, why am I waiting until tomorrow? Remember what I said, recruit, 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 sell, sell, sell. So you always want to be looking for good people, even if you can't afford them. You make them co-founders, you do whatever, you hire them for later. But you always want to be building a team. You have to think about the roles that you're going to need, and that's going to be very specific to your business. I don't know what's necessary in a beauty business, but whatever it is, think about the people you need. So let's say that you're the creative genius. Do you understand the marketing side of it? Do you understand the business side of it? You want somebody that augments your skills so you're constantly taking things off your plate. That's a way to think about this. Number 7, how do I know whether my vision is bold enough or just a fantasy? Well, we don't know. The best example of this I can think about is whenever we think of Elon Musk, it's the Elon Musk story of I'm going to Mars. And I think he was going to go to Mars originally with mice or something crazy like that. And then he changed the vision over time. But the idea was essentially, this massive vision of going to Mars. That's a vision, whether we agree with it or not. And here we are 25 years later. He still hasn't gotten to Mars, but he's made his investors a ton of money along the way. Have a bold vision. Have a big, hairy, audacious vision. There's absolutely nothing wrong with it. Number 8, in your experience, what kills early stage brands more than lack of capital, wrong positioning, or founder burnout? Well, those are 3 pretty good things that'll kill it. It's usually not so much founder burnout, but you have to be fanatical, which maybe does go to burnout. If you're not fanatical, nobody else is going to be fanatical about what you do. That's the first thing. If you're going to have co-founders, they've got to be fanatical too. You have to be able to execute, be in the details. That's 3. I think I did a video on this subject also, by the way, which you can find on my YouTube channel. Those are 3 things that pop right into my head. What's going to kill a company? If you can't execute, you can't build a team. If you're not fanatical, there's always going to be ups and downs in a business. Those would be the things I would think about. Okay, and number 9, what are the key signals that investors like Y Combinator or WebFunder look for in a pre-seed consumer startup from a developing market? Don't know. I don't know what Y Combinator would look like, but I'm just going to guess it's going to be something different and unique. They're going to look at you as the founder and say, okay, do I believe in the founder? Which is, by the way, what most people make decisions on for early stage companies is, do I believe in the founder CEO? Yes or no? All right. And the 10th question is incomplete. So we're going to go back over to our YouTube audience and go there. Okay. I'm in talks with an investor who agrees with our framing and likes our plan. He's just waiting for the market to take another turn. How can I get him fully on board? Okay, another excellent question. I like this question. So this is kind of the problem, right? Especially when we're in economic times when things are going up and down, which sometimes happens, right? You have hot economies, you have cold economies, and then, there's a lot of, especially here in the United States right now, there's a lot of uncertainty, because of tariffs and other things going on right now. So many times what investors will do in these situations is they'll pull back because they can wait and they can be patient. So what can we do to change that? The way we can change that is if there's competition for the deal. If it isn't just your one investor, if there are multiple investors competing for the deal at the same time, then that's how we change the equation. So how do we do this? So let's say we've got 2 and you have to really gauge this. If there are multiple people really excited, the best way to do this is set a deadline. So here we are, end of July. Why not set a deadline of the end of August? So August 31st. That's the deadline. I'm going to be accepting term sheets until August 31st. Magically, what happens is if there's a lot of people interested, magically they'll all start giving you term sheets right around August 31st. That's the way you change the game up. And that's how we know whether or not they're bluffing or not or whatever. Okay, next question. How to judge a technical founder being non-technical? I'm not sure I understand that one. And if I vibe with the potential technical founder, but isn't intellectually equal in business because he's starting out, would that be fine enough? Don't know, but here's what I would tell you, the things that I would be interested in from a technical founder. First question, how are you going to build your team? This is really important. Remember, we got to recruit. Doesn't matter who they are, they have to be able to. How are you going to build your team? This is the first question. This is a fail, no fail question. If they don't have a clue how they're going to build their team, I'll tell you a quick story about this in just a second. They're out. So we had, when we were looking for a technical co-founder, my original technical co-founder ended up not being good. Was looking for a second one, and we're looking for another technical founder. And one of my other founders found this guy and loved him and said, Brett, you got to meet him. And I asked him that question. He said, I'm going to go on bike rides. Did like this double take and was like, what? Bike rides? Yeah, I'm going. I really like biking. I'm going to be on bike rides, and that's how I'm going to find my and build my team. Not going to happen. So that person was out. So that's the first question, right? If they can't recruit, if they don't know how they're going to recruit, and they don't have a logical answer of how they're going to get their team, they're out. Second question would be, are you going to bring anybody with you from your previous company? That would be the second question that I would ask. Are you going to bring anybody with you? That's the second question. So that's what I would want to know. Hang on for 1 second. I'm trying to figure out how I'm going to go do this. So let me go do this. Sorry, I'm killing an ant. Okay, got him. Okay. Sorry about that, but I didn't like seeing that ant on the wall. Anyways, let me get back to what I was saying. So that would be my second question is, are you going to bring anybody with you? Again, for any senior executive, or we're going to bring somebody on, then this is part of it too. And again, this is like a yes, no thing. If they're not going to bring anybody, that's like a big red flag. So you kind of want to understand that piece. So those are kind of like the two key things I would want to know from a team perspective. The third question might be, okay, great, I understand that. So the third question might be, all right, tell me how you're going to manage the team. Tell me about what's worked. Tell me about your project management focus and philosophy. What are you going to go do? I'd want to understand some logical approach that they have to this. Tell me about a failure that you had, would be a fourth question. Tell me about a failure that you had of something that failed and why it failed. What did you learn from it? Everybody's had failures. What's yours? So this kind of gives you an idea. You want to understand whether this person knows what they're doing. It can build a team and manage a team. That's what you're after. And then you also want to understand from a business perspective, do they understand the business? Because there's nothing more dangerous than a technical co-founder that doesn't have any business sense. I had one of those. Those are disasters. And fortunately, I replaced him with somebody who had very good business sense, and that turned out to be really good. Okay, so let's go to our next question. Is there any way to salvage a relationship with a VC who ghosted you? Does setting a deadline for term sheets apply to that scenario as well? No. If they've ghosted you, they've ghosted you. So saying to somebody who isn't responding to your emails, I'll give you till August 31st to respond. No, it's not going to work. So unfortunately, that's part of the problem in dealing with investors is they do ghost you. Sadly, it happens a lot. So if we can avoid that, let's avoid that, as best we can. there's nothing we can do about it in one sense. People, it happens to everybody. Happened to me. I hate radio silence personally. It drove me insane. So I totally feel your pain on that one. Um, there's not a hell of a lot you can do. What you can do, the only thing you can do with investors like that, if you want, is you can do what I call the non-follow-up follow-up, where you can send them information about the company. Hey, we just added this person to the team. Hey, we just got this new customer to buy from us. Hey, we just announced this product. We made this improvement to the product. Things like that. In other words, you're not asking them to do anything. You're just giving them updates and making them realize, hey, you're missing out on something here. Better start getting involved. All right, let's got time for maybe one or two more questions. Ways to make money with a smartphone. Don't understand that one, so I'm going to move on. Can you tell one or two stories about due diligence nightmares that kill the deal? I don't know. The nightmare with due diligence is that you end up with people that don't know what they're doing sometimes. So that's the biggest nightmare about the deal killer is sometimes, and many times, investors will bring in a quote unquote expert to talk to you, and the expert doesn't know half of what you know. And then it turns into a quote unquote business meeting where they're trying to assess the business and they don't know up from down. Those are the worst ones. And I always kind of felt like it was Russian roulette with those meetings. And you just deal with them. And many times it's just a checkbox that investors need to have, to placate the rest of their partnership. So I wouldn't worry about it too much. That's when I think about due diligence. That's what I think about. The other nightmare is, and this happens more and more, is investors backing out at the last second, or which then leads to investors giving, which is the worst nightmare of all, is investors give you a term sheet, and while you're closing, they decide they're not going to do the deal anymore. That's the worst. That is just painful beyond belief when that happens. Okay, let's see what we've got. Why is it a red flag? This is, I think, going to be my last question for today. Why is it a red flag if they don't bring someone from a previous company? That's easy. They can't recruit. They have no following. That's why. So this is, by the way, just to answer the question a little bit more detail here. So if we're hiring a senior executive, be it CTO, VP of engineering, a VP of marketing, VP of sales, whatever we're going to call these people, anybody who's building a team, who's got some level of experience, typically people like that have people that want to work with them again and again. It is a red flag if this person isn't going to have anybody come with them. And let me tell you, as somebody who made this mistake, who didn't ask that question to somebody, in fact, I just did a video on this actually very recently. So you can probably see this in one of my recent videos where I talked about this exact thing that happened. And part of the reason I did it, because the person was, by the way, this was also a red flag. The person was recommended by two of my board members that I go hire this person. I just assumed, oh, he's already vetted because the board members like him. And that was a mistake that I shouldn't have made. And he didn't bring anybody, and he wasn't going to bring anybody. And the red flag should have been going off all over the place, because if you have experience and you can't have anybody join you, nobody wants to work with you again. That's the flag. That's the worry. It's like, why wouldn't somebody want to join? Why can't you find anybody that wants to come with you? So it's all about recruiting and being able to build a team and reduce risk. And your risk, by the way, it's not just investor risk, it's yours. So the red flag should be going off all over the place for you. If somebody, and again, it doesn't matter what the discipline is, but if they can't bring anybody with them, and it doesn't matter whether they can tell you who the person is or not, or persons are, but they should be able to say, yeah, I have people that are coming. Absolutely. There are people that I'm going to want to bring with me that are going to join. Great. That's what you want to hear. If they're now, and by the way, one of the other questions, the other question I missed, which I should have said, and this also goes to team building, is how'd you build your last team? How'd you do it? That's also a very insightful question because if the answer is, well, I inherited the team and I didn't add anybody to the team, that's a flag. So I hope that helps. Okay, final question, which is the follow-up question on this, and then I'm going to go. But do we even get those experienced people when you're a first-time startup founder? Yeah, you do. You absolutely do. Now, again, this is going to depend upon your background, your experience. But yes, now if you're coming out, let's say, for example, you're a very young founder and you've got 2 or 3 years of experience and you have a very young team, that's a different story. And that may lead to a different answer to this different story, that we're talking about here. And it may be harder for you to find these experienced people, but ideally, you're going to, again, it depends upon business and industry. So I'm giving a general answer to a general question. But yes, you can absolutely, first time founders can absolutely find experienced people. That's the thing. The bar, I want to make sure you understand this. The bar is really, really high here. If you're trying to build a company, you want the best people around you. The bar is super high to be able to do this. And if you're going to be looking for investors to invest in you, the bar is even higher. Think reducing risk. You want the best people at the beginning because that sets the table for everything else that comes afterwards. So I hope that helps. Okay, that's all we've got time for today. So I want to thank everybody. It's been fun as always answering your questions, and maybe I'll do it again next week. So take care, everybody. Bye.